Welcome to another episode of Investing Made Simple. I'm your host, and today's episode is all about mutual funds. I'm confident that you've heard of stocks, but have you heard about mutual funds? I think we can all mutually agree that this episode is going to be pretty interesting. So buckle up and get ready to embark on an exciting journey into the realm of diversified investing. Welcome to Sustainable Sense, where we invest in climate defense. You're in for our hot take on all things money, markets, and the environment. Before we start today's episode, we would just like to highlight some major positive news in the corporate climate world. Just take a listen to this clip.
By 2030, all Apple devices will have a net zero climate impact.
All of them?
All of them.
They better.
They will.
Just a few days ago, Apple committed to being completely carbon neutral across its business, products, and manufacturing supply chain by 2030. Apple actively collaborates with governments, businesses, NGOs, and consumers worldwide to advocate for stronger environmental protections and the transition to clean energy. Just imagine, if Apple starts doing this, then a whole wave of sustainable investments in public corporations will definitely follow. As more people are informed about this kind of thing, a brighter future is definitely on the horizon. Now let's get on to today's episode. Imagine you and a group of friends decide to put your money together to buy something, like a video game or a big pizza if you're a foodie like me. Each of you contributes a certain amount of money, and together you can afford to buy the thing you want. Now, replace the friends with many people, and instead of buying a physical item, you're investing in a collection of stocks, bonds, and other assets. That's basically how a mutual fund works. Picture a mutual fund as a team of experienced professionals, investment managers, working together to help you achieve your financial goals. These investment managers gather money from individual investors like you and pool it into a single fund. Mutual funds are designed to provide diversification, which means spreading your investments across a variety of asset classes, such as stocks, bonds, and sometimes even commodities or real estate. Diversification is exactly like the phrase, "don't put all your eggs in one basket." Like we talked about in the mini-series part 1, go check that out if you haven't already, a stock is a piece of a company. It's not a physical piece, but part ownership of the company. So think of diversification as planting different types of seeds in a garden to reduce the risk of relying solely on one type of plant to survive. In the case of a disease that wipes out one plant, you have the others in your garden. When you invest in a mutual fund, you buy units of the fund. The value of the units goes up or down based on the performance of the assets the fund holds. Each share represents a proportionate ownership in the fund's overall portfolio, so if one fails, you always have the others. The great advantage of mutual funds is that they allow you to invest in a wide range of securities, even if you don't have the time, expertise, or capital to do so on your own. And I think that applies to a lot of people here. You can benefit from professional investment management and research, even with a relatively small investment. Another key feature of mutual funds is liquidity. Imagine you have a jar full of your favorite candies and you want to be able to get some candies whenever you want, right? So that's what liquidity is all about. With mutual funds, you have the freedom to buy or sell shares whenever you want, just like taking candies from your jar. Unlike some other investments where you have to wait for a specific amount of time, mutual funds usually let you do it every day. At the end of each trading day, the mutual fund calculates its net asset value, or NAV, which is like figuring out how many candies are in your jar. Based on this value, you can decide if you want to buy more shares or sell the ones you have. All this candy talk is making me hungry. On the note of candy, mutual funds come in different flavors to suit various investment objectives. For example, you may find equity funds that focus on stocks, bond funds that invest in fixed income securities, or balanced funds that aim for a combination of both. It's important to consider a mutual fund's investment strategy and objective before investing. Some funds may aim for growth by investing in companies with high potential, while others may prioritize income generation through dividends and interest payments. One crucial factor to keep in mind when assessing mutual funds is the expense ratio. This represents the annual fees and operating expenses charged by the fund for managing your money. A lower expense ratio typically means more of your investment return stays in your pocket. It's important to understand these fees because they can affect your overall returns. Additionally, it's important to evaluate a mutual fund's performance over time. Past performance is not a guarantee of future results, but it can provide insights into the fund's track record and consistency. Lastly, remember that investing in mutual funds involves risks, just like stocks. The value of your investment can fluctuate based on market conditions and the performance of the underlying securities. It's always wise to assess your risk tolerance and consult with a financial professional before making investment decisions. And that's a wrap on mutual funds. Mutual funds are generally considered a long-term investment. They offer a convenient and diversified approach to investing and allow you to tap into professional management in a variety of asset classes. So remember, do your research, compare different funds, and align your investment choices with your goals. And of course, sustainability. That's it for this episode of Sustainable Sense. If you have any questions or topics you'd like us to cover in future episodes, feel free to reach out on email at sustainablecentspodcast@gmail.com. Again, that's sustainablecentspodcast@gmail.com, or DM us on Instagram at sustainablecentspodcast. And until next time, happy investing.